With government debt topping $19 trillion, are your investments in jeopardy? Brian Relling is here. He's the co-head of global fixed income at Wells Fargo Investment Institute. So Brian, low interest rates also applies to the government, right? They're saving a lot of money on interest payments, but the big question is at the expense of investors?
Well, the low rates definitely help the government budget today. It used to be that interest expense was 12, 13% of the budget. We're down to about 6% of the budget today. In fact, we spend less dollars today, even though the debt's some 3 or 4 times bigger than it was 15 years ago. So that's been a benefit. But there's no doubt about it that the growing debt load, and especially as you go into the future with the aging demographic, the deficits that are projected begin to ramp up. And there's no doubt that this growing debt load and the aging demographics are disinflationary. So it keeps rates low, it keeps inflation low. And, the government at some point has to pay that money off, or those funds just come out of funds that could be used better elsewhere in terms of investment and consumption.
Right. Well, it's not just hurting investors, too. I mean, savers, too. Not everyone wants to be in the risky stock market. Yes. So we're seeing savings rates near zero.
Yeah, I mean, there's no doubt that this low rate environment is at the detriment of savers. So that's a big issue, I think, especially as the population ages. People essentially have to save even more for retirement because those low rates and those low returns mean that they're not going to have as much in retirement as they may have in a higher rate environment.
Well, that's what I wanted to ask you, sort of what is the solution? How do you balance both of this? Do you perhaps up your savings, but also try to put some money into the stock market? Because, I mean, we're seeing record highs on a daily basis.
Yeah, obviously it depends on the investor's unique situation, but we're seeing a lot of investors take more risk to generate income.
And return.
And return, of course. Now, we advocate that if you start doing that, you need to do so in a very diversified manner, not to become too reliant on any one sector of the market. But that's one thing we're seeing people doing. I think we're seeing a lot of people delaying retirement, so essentially working a little bit longer to make up for some of that gap, or potentially even working part-time in retirement. Again, you have to come up with some creative solutions when the market is just not going to give you those higher returns that may have been commonplace in the past.
Although we have a central bank that is, wants to raise interest rates at some point in the next several months. When do you think we see that next rate hike?
Well, I don't think it's going to be until next year. I think the Fed's on a very, very slow path here. No more than 1 hike per year. Again, they have an inflation expectation problem, and they also have the problem where the rest of the world is potentially, the rest of the world is easing, potentially going to add to their easing. So it becomes very difficult for the U.S. to go completely divergent and begin tightening. It has implications for the dollar, and you begin to get this negative feedback loop. I think we've seen this a couple of false starts in the past for the Fed around that same idea.
And even 1 rate hike a year isn't going to do much to help, your interest rate on your savings account.
No, absolutely not. I mean, if you believe, I don't fully believe, but if you believe the Fed's long-term federal funds rate of 3%, and you do 1 hike a year, and given where we're at now, you're talking about 10 years before you get up to those target rates, and obviously we're going to have some different situations over the next 10 years. That doesn't really seem realistic.
Yeah, well, this is a problem we'll continue to watch. Yes. Brian Relling from Wells Fargo Investment Institute, thank you for coming by.
Great, thanks for having me.
I'm Scott Gamm, and you're watching The Street.